where is she? She was asking me what's going to be on the midterm, right? So, here is the one of the questions on the midterm. Did you want to know the question for the midterm? Yes. Well, do you want to know the answer? Alright, so I'm giving you now the answer to one of the questions for the midterm. Okay? The midterm question is, what are the main or primary tools of monetary policy? This is basically one of the more important questions in central banking. Okay. So, first of all, monetary policy simply means how the central bank controls money supply. So, monetary policy is about control of money supply. And tools, pay attention, tells you how. How does the central bank do it? Alright? So, we're back to the same old stuff. Number one is demand for cash. Demand for cash determines money supply. And if you remember, I explained in great detail that the higher the demand for cash, the lower the multiplier, and eventually the lower the money supply. That was the paradox of central banking. Number two, demand for gold. If people want to hold gold, this basically means they don't want to hold banknotes, they don't want to hold cash, and they don't want to hold deposits. Okay, these two make the central bank relatively powerless to control money supply. That will be page whatever, 148. Number three. Is called discount window. Discount window is the mechanism of the central bank to provide loans to commercial banks. So, that's the mechanism. And the tool is called a discount loan. Discount loan is a loan given by the central bank to commercial banks. So, a commercial bank is a little short on reserves. This is effectively the central bank giving reserves to commercial banks. That's number three. The other type of loan is known as outright loan. Outright loan. The outright loan is on, or outright advance, they also call it. Outright advance. That's on page 150. This is like a secured loan given by the central bank to the commercial bank, and the commercial bank will give some form of a security. So it will give, let's say, a government security as a security for a loan. So we need to explain what is, okay, I'm writing now here. Security. Security has many meanings, but here the meaning of security is the same as collateral. Collateral is a noun. Collateral is an asset given as a security for a loan, and the lender can keep the asset if you don't pay back the loan. So a lot of times people want to borrow and they'll give their watch. Usually they prefer your gold, okay? But the bank would be happy to take as collateral, the most common collateral is your house, okay? So one very special type of collateral, which is most widely used everywhere in the world, is the collateral of real estate. And the collateral of real estate is called a mortgage. But you can put cash as a collateral, you can put gold as a collateral, you can put your car as a collateral, you can put a government bond, you can put stocks, you can put any asset, anything of value will serve as a collateral. So these are usually, we say, collateralized loan or secured loan. So when you have collateral, it's called a secured loan. Is a loan secured by a collateral. Alright, so that's the discount window. The next one is called the Fed funds. And sometimes we call it the Fed funds market. Fed funds is a deposit of the commercial bank to the central bank or in the central bank, and every commercial bank will have a deposit at the central bank. So when you're a little short on reserves, you can borrow from another bank that has a little excess reserves, okay? So if you're a little bit below your reserves and someone else is a little bit above their reserves, you can borrow. The borrowing is usually overnight. Overnight. So this becomes an overnight loan. You borrow the Fed funds of the other guy, and borrowing overnight means you borrow for 1 day. So this is typically an overnight. Fed funds market is the market where commercial banks get together and loan to each other Fed funds. Of course, if you're short, you can never possibly loan. You can only borrow. But usually happens is that some banks have excess reserves, so they'll loan them out to earn interest on them. And other banks are overall short. Okay. Well, this interest rate is called the Fed funds rate. Fed funds rate. Fed funds rate is the interest rate at which one commercial bank borrows Fed funds from another commercial bank. Now, jumping back here, we call that particular rate, we call discount rate. Discount rate. Discount rate is the interest rate at which commercial banks borrow from the central bank at the discount window. Okay. So, now we are getting to a tool. The discount rate will be one tool. The central bank can raise the discount rate, and fewer banks will borrow if it's expensive. The central bank can lower the discount rate, and more banks will borrow. In other words, if it's cheaper, they'll have more incentives to borrow. The Fed funds rate is another tool of monetary policy. The central bank can intervene in the Fed funds market and artificially raise interest rates or lower interest rates. In other words, the central bank can inject extra reserves at the Fed funds market, whoever wants to borrow and make it a little cheaper, or the central bank can withdraw reserves from that particular market. They'll sell a security. So they'll sell you a security, and instead of you lending her at 3%, you'll buy from the central bank a government bond at 3.5%. You won't lend to her at 3 when you can lend guaranteed at 3.5. So this is an important tool of monetary policy, and this is an important tool of monetary policy. This Fed funds is 151. And let's see what else I have. Okay. And number 5 is open market operations, page 153, page 153, and number 6 is the required rate of reserves. This required rate of reserves determines the multiplier. Okay? So this determines the money multiplier. These here, 3, 4, and 5, Three, 4, and 5 determine the reserves. Okay. So 3 4, and 5 are determinants of the reserves. 6 is determined on the multiplier. These, let me finish in about 1 minute. Now, 3 to 6 are determined by the central bank, and 1 and 2 are determined by consumers. They are determined by consumers' confidence. In other words, are consumers willing to deposit their money in the bank? Are they willing to use the bank's money? Are they willing to use the central bank's money? Okay, this is determined by and these are not tools. Not tools. So, this is a tool, number 3 is a tool, number 4 is a tool, number 5 is a tool, and number 6 is a tool. This is a tool to manage the multiplier, and these 3 are tools to manage the reserves. These 4 are tools of monetary policy. And next time, I'll explain in detail what are open market operations, and if there's anything left here, I'll complete. Okay?